Hey, good afternoon, everyone. It's good to be back and back with you. We've been kind of in and out of the office, but thank you to Jeff and Phil and Andrea for kind of carrying the water while we were out dealing with some stuff. But I hope everyone had a great holiday break and is ready to charge into the new year with more optimism than what the grain markets did today. So let's just jump right in and look at how those performed and kind of what drove them. I think what's got people's attention here today, I really think it's as simple as Brazil got some rains. Our forecasts aren't that bad. We have lots of bushels available. And if you just kind of look at the broader picture, if we have another big crop this year, then we're no longer in a deficit, we're in a surplus. And that surplus is expected to grow. So larger carryouts, bigger surplus, lower prices, very simple. And that's where the market decided to start with this year. So what do we have? This is the chart of new crop soybeans. We gapped lower at the open and just kind of stayed under pressure for most of the day. We did get a little bit of strength on the short-term charts. I'm going to pull that up and look at it, but not enough to say, oh, hey, we forged a low or anything like that. I think that we're looking lower, and I think that hedges ought to be put in effect, and really that's got to stay in place until we crawl back up above some of the support. So with a gap down here, that's one of three things, right? It could be an exhaustion gap where this move has exhausted the move lower. It could be a measuring gap where you would measure from here to the high up here, which is about $1 a bushel, and you would expect this to gap and go another dollar all the way down to, call it 11.20 or 11 bucks. That would be a measuring gap. We do have the Fibonacci targets down here at the 2236, which is 2.2 times the move to the upside. So that is a viable target, and it could also be a breakaway gap, which is counting something bigger than what we're even looking at here. So not good action on the bean side. I think we're going to have to go ahead and sell a little bit of strength overnight or tomorrow here and get hedged. If we're able to crawl back up above these lows and hold it on a closing basis, that might change our mind. But the reality is this isn't good trade action and something that we need to be looking to sell. So how does that carry over into other markets? Well, here is old crop corn, right? This is March corn. You've got a definitive break below the 370 level. That's bearish. So now if you just drew a horizontal line from here over, then that's your trading point, right? Anything below that, we're going to look lower. Anything up above that, maybe you find some strength, but really you can't get too bullish unless things crawl back up above this area. New crop corn, really no different. We have broken out below these lows here. So we had bought some call protection against short futures at the 510 level. We're going to exit those calls tomorrow if we close below these levels here again, and we'll rebuy them if we're able to break back up above this hedge line here. We'll put those calls back on. But if we do roll on over, then we'll take that small loss on those calls and just hold our short futures moving forward and make sure that we're hedged, because you just don't know where these things will go. I haven't done a whole lot of in-depth research on this, but to my recollection, I can't go back and find any December corn contracts that peaked on the first trading day of the year. I don't think when we did our back test of all of our stuff over the last decade that there was any one year where this marked the highest price of the year. I think that you always get some sort of subsequent rally, but the question in this business is where from? Because if we're going to move down to 450 or worse, then we don't want to carry it all the way down there without getting protection on. So we want to be sold here, and then we'll look to re-own at a later date. And if we do get a break, then hopefully the market gives us an opportunity to buy some calls back at discounted levels and from lower levels, so we can capture some of that gain in there. But for tomorrow, I think our plan coming in is going to be to exit the calls, hold the short futures, and what would negate that is big strength overnight that takes us out of there. But you can just kind of see the levels we're looking at. So let's keep it simple. horizontal line here above around the $5 level. We hold these on closing basis. We want to come out of them, and we want to put re-ownership on as we climb back up out. We can't make it any more simple than that, and I think that's a strategy we need to stick with. Okay, wheat. What did wheat do today? Wheat is actually the strong one of the bunch here. Let me take this retracement off to make it simpler. We have a we're holding these lows here. We have a 12 here, and today we have a star. So what does that mean? The star means that we would have a red 13, which is a buy signal on wheat, but we didn't get low enough because we need to violate this this level over here in order for that to confirm a 13. And what does a 13 mean? Well, it's another way to look for divergence, right? Where your oscillators are finding higher lows with lower lows. So a 13 is kind of the same thing. It's showing trend exhaustion or trend end, which is something we've been looking for in the wheat market. Now, let's be realistic. Can corn drop to 450 and the price of wheat not come lower? Let's just say that wheat stays sideways at 630 and the price of corn drops to 450. Well, that would put us a $1.80 discount corn to wheat, and I don't think that that's realistic. And I'm not going to jump into it. I'll do it on another video, but we'll look at that corn wheat spread, and at 250 or $2 it starts to get pretty out of whack, where wheat is overvalued to corn. So either corn's got to come up or wheat's got to come down into that vision. But the market is very clear with what it's doing right now. If corn breaks lower and widens that spread out, it's telling you that wheat is more valuable as a feed source. So we're going to store wheat, and we're going to hold, and we're going to push corn into the market because it needs to be fed. It's making corn more affordable than wheat, taking wheat out of the ration. What we would rather see happen is corn explode and make wheat cheap, right? That's a different situation because then wheat demand goes up. So not a great situation where we are, and if corn drops lower, I think it's hard for wheat to hold its course here without going lower. So we're going to be looking to be sellers definitely if we give up these levels in here, and we just want to be realistic that there's no law that says we have to bottom or we can't go lower at the beginning of the year, even though seasonality would suggest maybe we need to find some higher prices. So we'll just have to take it a day at a time and just kind of see what the market gives us. But for today, we're definitely leaning bearish based off of corn and bean action, and I wouldn't be surprised to see wheat kind of give that up, absent some sort of an event or catalyst that goes higher. And I think that can be said across everything. We just don't have the catalyst. We don't have the demand. We don't have the, we don't have the war. We don't have the weather. We got to have something that makes buyers eager to buy bushels out of fear of running out. And we don't have it. So we have buyers that are just going to be content to bet on lower prices because we got big yields coming and we don't have the demand numbers to sit on it. So it's a market with a bearish tilt to start the year, and I don't see what's going to change that in the near term. But I think we'll see that first materialize on the charts, but it's not today. So we're worried about the downside. I think it's really important to be managed and be hedged. I hate to be super sold too far out, but again, that's why we've had our corn hedges on for a while, just because this thing feels pretty heavy, and it looks like lower prices could be the theme of the day. So what could be the catalyst? More drought, confirm smaller crop size out of South America, buyers moving into the U.S. to start buying because they're worried about the weather in South America. Those are all things that would help change the tenor here. But I think we got to have something like that to get us to off a dead center. So I think a proactive approach is better than a passive one here, and hedged is better than not. With that, I hope you guys have a great night. Remember, there's always risk trading futures and options, and you should only do so in light of your own financial condition. Hope you guys have a wonderful night. We'll be back with you. Tomorrow is Wednesday, so we'll shoot another video and get back on our regular schedule. See ya. Have a great night. Bye.